What is ROFR? ROFR. It stands for Right of First Refusal. So I've helped some early employees or shareholders get liquidity for their shares or their options while their company's still private. And at the beginning of every process, it starts with a few questions to understand the specific situation. It's one, what's the background? Why are you selling? Two, have you gotten approval from the company to sell your shares? And are your shares subject to ROFR? A lot of times, early employees don't know the specifics, and nor should they need to, but ROFR, that right of first refusal, means that if you as an employee want to go sell your shares, there's probably a process, guidelines, and a timeline that's outlined in your shareholder agreement, which states what you're allowed to do, what you're not allowed to do, and what that process looks like. So, very high level, that right of first refusal is typically held by the company or some large or strategic investors. It's completely understandable. The company wants to control their cap table. They want to control access to information. They want to control a situation, and they're in business to go and solve a problem or execute on a certain mission. They're not in the business to try to facilitate secondary sales or tender offers. Yet, it's also very reasonable and understandable as an employee. Stock options or equity is form of compensation, and if your company's staying private longer than you expected, and as is the case, and you have a life event, something happens, you need liquidity, you want liquidity, you should have the ability to sell those shares. But there's a process that it needs to run through, and this ROFR process is kind of what kicks off in some cases, or getting the approval from the company is really what kicks it off. And then if the company allows you, and the shares are subject to ROFR, you're going to need to go and find a buyer who's looking to acquire your shares, set terms, and then present that offer to the company. And now the company or those shareholders have the right to say, got it, we'll take those shares at that agreed upon price. So it becomes really tricky if your shares are subject to ROFR, and if your company doesn't want you to sell your shares, it's going to be a nightmare, and we don't touch that anyway. But if the shares are subject to ROFR, that also means that buyers may not want to dig in and do the level of diligence that's required to properly underwrite and properly price the shares, because they could do all that diligence, and then the company or strategic investor says, thank you, we'll take those shares. So if you're an early employee, if you're a shareholder, and typically this more so applies to employees because investors know the rights, they know these details, it's important to take a look at your shareholder agreement. It's important to understand what rights you have and what that process looks like. So get yourself educated, take a look, and if you need liquidity, there are lots of solutions out there to help you get liquidity for your options or your shares.